morning, everybody. Thank you so much for joining us for this Future Faces professional development event today. And we are really excited that we have got our very own Nadia. So for those of you who don't know, Nadia is part of the Future Faces committee. And she's actually well, it's not officially been announced yet, but she is going to be our new vice president as well for Future Faces, which is really exciting. So we've been wanting to do an event like this for a really long time. I know that personal finance is something that most of us don't understand. We don't get taught about it at school. We just kind of let out into the real world and we're expected to understand pensions and mortgages and all that stuff. So it's we're really grateful, Nadia, for your expertise and your time this morning. The way that the session's going to run, guys, in a minute, Nadia is going to introduce herself and talk a little about who she is and why she's an expert. And then Nadia's going to do a little presentation. So she's going to kick off with some really interesting information for us to hopefully digest. And then it's going to be in a Q&A format. So any questions that you've got, anything you don't understand, please just submit your questions. So you can do that at the bottom. There's a Q&A box. It's a little, but you'll see at the bottom of the screen, there's a little bit of a little bubble with a question mark, and then it says Q&A. And then there's also a chat box. So if you prefer to use the chat box, you can, but it would be easier for me if you did it in the Q&A box. And then we've got some questions that were sent in advance of the event, so I've also got some of those to ask as well. Just quickly, I think is your colleague Debbie joining us, Nadia?
Yes, yeah, Debbie should be on the call.
Okay, so I think do I need to invite her to join? I think yes, I think I've done that. I think you're invited to join, Debbie.
Thank you. Can you see me?
Yes, we can hear you and we can see your name, but we can't see your.
Yeah, I don't know how to get my picture up. I don't usually use Zoom, so if somebody wants to see me, perhaps I might need a bit of a hand on how to show my picture on here. Hey.
If you click on the box, if you hover over your box, there should be 3 little dots, and it should let you show your video. I think.
The top line, are we? Very top line. I'm hovering over it now. That's just filtering it.
Oh, it might be in the bottom. It might be in the bottom left where it says video.
Right, I've got audio, chat, lower hand, Q&A, show captions. I don't want to leave.
We might just listen to your lovely voice.
My lovely voice, yeah.
You'll have your dulcet tones, Debbie.
Shame you can't see me. That's a real shame.
Oh, we've got your picture on your slide as well, so
all right, that's fine. I'm happy with that. So,
well, if I hand over to you, Nadia, do you want to talk a little bit about who you are and what you do?
Definitely. So hi everyone, thanks for joining today. I know that we've been waiting a little while to get this session put together, so it's really nice to actually get to speak to you. So an introduction to me. So I'm Nadia, obviously part of the committee and new vice president. And I was lucky enough to win at GBYPY last year in the finance category. And since winning that award, in the fabulous picture there with the lovely award, what's actually happened is I've had loads of amazing opportunities to run workshops, to go into people's workplaces and actually share about financial planning and get people introduced to financial education. Like Sophie said, we don't get taught it in schools, we don't get taught it at college, university, we're just thrown out there and expected to pick things up along the way. But if people like myself and the other amazing financial planners within Future Faces can get out there and give people pointers, that's what we want to make happen, and just give people a good grounding of where to start. So let's go on to the next slide if I can.
We can't see your slides yet, Nadia.
You can't see them. Let's have a look. Let's start sharing again.
Is something's happening? Yeah, there we go. We can see them now.
Success. There we go. So you can see the lovely picture from the awards there, which I hope to see everyone at in October. Book your tickets, get in there. But like I said, it's an amazing opportunity to really get out there and spread that financial education message. Okay. So in terms of the world of financial services, there's always going to be a compliance risk disclaimer. So essentially, we need you to know that I'm authorised and regulated to give financial advice. So I'm qualified to tell you things today in terms of financial information, but also the firm where myself and Debbie work, they're also regulated. So if ever you meet anyone online or out and about that you're not sure if they're telling you the right thing in terms of financial advice, go and check them on the Financial Conduct Register, and that's where you can check they are who they say they are. Okay. So what we're actually going to cover today, so like Sophie said, we've had some pre-input in terms of questions and what people want to hear today. So about pensions, investments, saving, protection, and then also mortgages, which is where my lovely colleague Debbie comes in. So she is going to talk about how to get your mortgage ready, and we've got a slide together of the really important key considerations in terms of mortgages. So what is financial planning? So I went on Google and asked the lovely AI bot, what is financial planning? So essentially what it is putting together a plan for someone for their future. So we look at where they are now, what cash have you got, what investments have you got, what pensions, what do you want to achieve in the future, and how can we make you get there? So that's where we come in. So in terms of what a financial planner actually does, so I'll let you into a little insight of what our days look like. So most days I'll be travelling up and down the country in people's homes and getting to know them and what's actually important to them. Because it's such a personal thing, we tend to find it helps being within people's homes to have these discussions, because you feel more open to talk about what's important to you, your family circumstances, and it just helps to get to know you that little bit better. So in terms of financial planning, there tends to be a basic pyramid structure. So without a really strong foundation, the top essentially could crumble. We need to make sure we've got that really good base in place. So what we'll talk about throughout some of the slides is, well, have you got a really good emergency fund in cash savings? If you don't, then we shouldn't be looking to tell you to invest, because what if the car breaks down and you need £700 to fix it? If we haven't got that money in cash aside, we're going to have to go and seek credit. We're going to have to seek loans, and that's not the best position to have to be in. So we want to make sure there's always something aside to keep you safe. In terms of protection, which we'll cover in more detail later on, again, we want to make sure you're safe in the event of something unfortunate happening. So if you can't go to work for the next 6 months, how are you going to make sure that you can still pay your bills? We want to make sure that you've prepared for the unexpected in case things happen and change. Then through financial planning, once we know you've got that safe base, we'll look at, well, what investments can we do to help you have a better financial position? How can we make the most of your salary and the money that's coming in to really make it work for you? And then at the top of the pyramid, we've got holistic planning. So that's where we work alongside some of the lovely solicitors and accountants within Future Faces in terms of, well, have you got your will put together? Have you got lasting power of attorney documents in place to make sure if you can't make your financial decisions, you've got someone you trust who can make them for you? So that's where we all come together as a network to make sure you're in the best position possible. So what we'll start doing now is going into the nitty-gritty. So I know, talking to Sophie, this can be a little bit of information overload. So what I'll do, I'll give a quick overview on each section, and anything that you're not sure of, ask in the Q&A, or we can also follow up afterwards. So don't worry about taking everything down. Okay, so what is a pension? Essentially, it's a way of saving for your retirement and an investment wrapper. So what that means is you'll contribute into your pension maybe on a monthly basis through work, and it helps to build up a pot that you can access once you do retire in the future. Why pensions are so good in terms of tax efficiency is that for every personal contribution, you'll be eligible for some tax relief on that contribution. So if I'm a basic rate taxpayer, for every £80 that I pop in personally, I'll get £20 worth of tax relief added on by the government. Therefore, I've actually got £100 that's going to be invested for my future. And that's the way of the government trying to incentivise people to save for their own future. So they're going to give you that little bit of something for everything that you can contribute. If you are lucky enough to be a higher or an additional rate taxpayer, there's extra relief that you can claim, but that has to be done via self-assessment. So if you are in that position to be a higher rate taxpayer, please make sure that you are claiming that extra relief, because you might be missing out on money that you're just not claiming. So that's really important to remember. So in terms of young professionals, I know a lot of people when I have conversations say, well, I'm not going to retire for another 40, 50 years, so why do I need to worry about it? And yes, it's true that we can't access them until 55 at the moment. But what is really clear from the clients that we see, little and often from a younger age makes a massive difference by the point you get to retirement. A lot of people only seek financial planning advice in the year before they're going to retire. If we don't have enough in your pension at that point, unfortunately, we're very limited in what we can do to make that position better, because there's just not that much time left. So if we can get that advice in early and start saving early, you're going to feel that benefit later on. Okay. So one thing that's interesting as well, when I speak to young professionals and you say, have you got any experience of investing? A lot of people will say no, but have you got a workplace pension? Yes. Okay, well, that's invested then, isn't it? We just maybe haven't had that much of an input in terms of where you're invested. So that's something that is really important to explore. Where is that money actually going? And is it doing what you want it to do? So that's where us as financial planners come in. We can assess what funds you're invested in. Is it actually giving you a good return? What charges are you paying underlying for that investment if it's not actually doing what you want it to do? So that's where we come in. Also, a big area we tend to get lots of questions on is salary sacrifice. So essentially what that is, you can agree to reduce your overall salary in exchange for that money going directly into your pension. Because the money goes directly into your pension and is sacrificed, that money hasn't been liable to income tax or national insurance. It's just going straight to be invested for your future. Therefore, it's a really good tax efficient thing to consider if that's something your pension provider can allow for. So what I'll do here, a couple of the slides have popped some key tools in, so we can speak to Sophie and Demi and see if we can share these out if anyone wants them in the future. So we often get questions about, well, I've had 5 different jobs in the last 10 years and I've got tiny little pension pots at each place, but I can't remember where they're actually invested or what I've got. So this first tool through the government website, as long as you know the name of your employer, you can pop it into the tool and they'll tell you which pension management company actually run that employer's pension. You can then contact that address that you're given with your name, national insurance, date of birth, and they can help locate if there is actually an entitlement for you, or an advisor like myself can help support and find that provision for you. So it's just a really key tool if you want to have a little look there. Also, we know that the new state pension, you need to have 35 years worth of national insurance contributions to be eligible for the full amount. So with the state pension forecast, it will tell you, well, how many years worth of contributions have I got so far? How many more years do I need to get that full entitlement? And as we get later into our career, it becomes that little bit more important of, well, how much potentially am I going to get from that state pension? It's not just guaranteed that everyone, regardless of their history, will get a certain amount. Fabulous. So on to savings. So another key area that people ask about. Oh,
I'm interrupt Nadia, but I'm just wondering, just because you've talked about pensions, do you think it might make sense if we answer a few questions about this topic? I'm just thinking it's a lot of information, and people, if they've got questions now, people might forget.
Go nuts.
Would that be all right? Sorry to jolt your flow. Because I just had a few questions about things like, I guess, I guess when we talk about pensions, it's really difficult, like you say, to think about one day when you retire because it feels so far away. And um, I guess what we take for granted, what our generation take for granted, is the fact that the workplace pension is now a legal requirement from
Oh, I think
employers.
I've lost you, so if I can't hear the end of the question.
Oh no. Um, can you hear me now? No. Hello?
Hello, I can hear you now.
You can hear me now. Um, so just it feels really far away to think about retiring. So I guess we take for granted that our work has to offer a pension, and that wasn't the case 20 years ago. Um, so I guess one, we don't really appreciate that. So I think really important what you were talking about, merge, like how do you merge your pensions, and is that something you should do? Because I know it's something that a lot of people don't think about, and then you kind of get down the line and you think, should I do it? And there's a lot of confusing information about should I leave my pensions where they are and then worry about that when I retire? Or does it make sense to bring them all together? Does that mean that they earn better interest? Does that, can you
Yeah,
help with that?
course. So that tends to be a big bulk of the pension work that we as advisors cover. So in terms of having lots of different pots, a lot of people, even just in terms of administration, they want to consolidate them. So there's one pot for them to manage. They don't have to think, well, who manages this bit of money here, there, and everywhere. But something that's really important before you do just consider consolidating them all into one provider is you need to double check if there are any protected benefits on any of those pensions that you have. So some providers might give you a slightly increased amount of tax-free cash on older pensions that wouldn't be available nowadays. Some of the investments might give you a discount on the charges because you're in an employer scheme. So if you were to move away from that scheme, there might be higher charges based on the investment that you'd be going into. And what you have to look at is because each investment would be potentially in a different fund, have different performance, different charges. Well, we don't want you to consolidate into one that's got the worst performance. It's really expensive to run and it's not actually doing what you want it to do for the future. So that's why it's really important if you're not sure and you need support to go and ask that question to an advisor saying, is this the right thing to do for me? Because for a lot of people, consolidating is a good thing to do, but there are occasions where you may be losing a benefit if you do that. So you just want to make sure you're really careful.
And then we've had a couple of questions in the Q&A box. I'll just ask those as well. So one question is, once we know where all the places are, so we know where all of our pension is, what is the next step? How do we actually request for it to be in one place?
So what you do, you can approach an advisor and say, these are all the different pots I've got. Can you support me in making a recommendation for consolidation of where it should be invested to make sure it's doing what I want to do? Therefore, we as the advisor would take on the administration burden of contacting all the providers, reviewing where it's invested and where it should be invested, and any potential benefits you've got. If you want to do it individually without advice, which everyone has that right to do, but you've got to be careful you're doing the right thing for you. You can contact each of the providers individually and say, what would your process be if I wanted to transfer it into one of my other pensions? Usually there's forms to fill out, transfer forms essentially, but if you do have multiple providers, it's a little bit of an administration burden to take on yourself if you're not too sure what you're doing.
And then another question that we've had is, how do I claim or move a pension from an old employer that's no longer in business? So if they've worked for a company that doesn't exist anymore, how does that work?
So there's something called the Pension Protection Fund. So it might be that if that business has gone bust, but you had a pension entitlement with them, there might be the opportunity to find what entitlement you are due through the Pension Protection Fund. So that's something you can look into. But again, if you've got all the details of your employer, just show them to an advisor and say what might be the best next steps in terms of locating if I've got anything that I'm entitled to from this business.
And then another question about the pyramid that you talked about before. So if cash savings are the foundation and you don't have any cash savings, should you be paying into a pension?
So through your employer, yes, because we know auto enrolment, you have to do that from your salary automatically. Should you then be going and setting up a private pension to contribute to each month, would suggest you should be focusing on building a cash buffer first before then you go to invest, because we know that investments can go down as well as up, so it's not a stable value. But also with a pension, you can't access it until after 55. So in an emergency, if you've put that money away, you're not getting that back. So that's something to consider.
And then the next question, which I was about to ask, but someone's asked it. So clearly it's a question on the top of everybody's tip. What about like how much cash should people have? So you talk about like having a cash amount. I know the answer is going to be different for everybody. But I guess, yeah, average young professional, I'm guessing the average age of the people on this call is around 25. They'll all be in different kinds of jobs, some of them in hospitality, some of them in marketing, some of them lawyers. But roughly, what would you suggest?
Yeah. So as a rough guide, generically, no matter what your kind of role is, we say 3 months expenditure as a minimum. So that means that if you were out of work for the next 3 months, you've got enough to pay every single bill that you know you have to pay and to keep your food going and things like that. That is the minimum. So if you're someone who knows, well, I need to pay off my car payment within 6 months, well, you know that you need more in your cash buffer because you've got a big expense coming up. So that's where it tends to fluctuate. But as a base minimum, I'd say 3 months expenditure, just because that gives you a little bit of a safety net if anything happens and you can't work for some reason.
Okay. And there'll be people on here going, I have no idea what my expenditure is. And that's fine. But maybe, at some point over this weekend, I hate spreadsheets. I'm sure people in finance love spreadsheets. But maybe just get an Excel spreadsheet open this weekend and just have a little look at what your outgoings are, what you normally spend. You've got to start somewhere. So don't after this call think, oh, forget it. Let this call be really your sort of motivation for starting and having a bit of a think. I've got a great question that leads us very nicely onto your next slide. So the question is, I have a workplace pension, but I don't know if it will be sufficient when I come to retire. Is it would it be better for me to invest in my lifetime ISA or carry on with my workplace pension?
So with your workplace pension, there's minimum contributions that have to be made. So a total of 8% between your employer and you has to go in based on government legislation at the minute. So we can't really avoid that based on rules at the minute. But in terms of your lifetime ISA, there's a £4,000 limit per tax year of what you can put in, which makes you eligible for a 25% bonus on up to that £4,000 per tax year. Whereas pension,
just if anybody doesn't know, what's the tax year?
It's April to April.
Thank you.
Yeah, perfect. So in terms of that lifetime ISA, the main purpose of that investment is either to fund a bonus towards your first home or as an additional savings pot after age 60 towards retirement. If you were to draw on that lifetime ISA for any other purpose, you will lose that bonus element that you've accrued over the years. Therefore, it's kind of an alternative to a pension, but if you've already had your first home, you're locking away that bonus for later in your life. So again, it's just something to consider about, when do I want to use that money? Am I going to want it for 10 years' time and not towards a house? Well, then maybe a different type of ISA or savings account might work better for you.
Brilliant. I think that's it from that. So if you want to carry on now, I'll be quiet.
So just carrying on from that then. So in terms of your lifetime ISAs, just stay on that one. So you can take out a lifetime ISA, anyone who's over the age of 18, but you have to take out the account before you reach your 40th birthday. So like we said, there's two main reasons that you tend to go for the lifetime ISA. either to boost your deposit towards first time buying or as an additional pot towards retirement. The great thing about ISAs is any withdrawals from them in the future aren't liable to income tax, and any growth within the investment, it's not liable to capital gains tax. So essentially what that means is what you put in, no matter how much it grows, you can take that out and the government aren't going to be trying to claim back some extra tax on that savings for you. And because that's a really good tax efficient benefit, that's why they limit the amount that you can put into ISAs each tax year, because they don't want everyone getting unlimited benefits, essentially. They're trying to manage that. So in terms of a normal adult ISA, so you can have cash ISAs or you can have stocks and shares ISAs, depending on how long you want that money tied up for, how much potential for growth you want, whether you just want to see a stable value with a guaranteed amount of interest, or whether you're willing to experience some fluctuations in the stock market to potentially have a much bigger growth on that investment over the longer term. So with an adult ISA, you can contribute up to £20,000 per tax year. So again, they're just limiting the amount you can pop in just so everyone's not getting too much of a benefit. In terms of a junior ISA, so that's what we call a JISA, you can save up to £9,000 per tax year for a child, essentially. So if you've got children and you want to save for their future towards their first car, a house deposit, something like that to give them a bit of a boost, that's a great way to save for their future. But one thing I would say about junior ISAs is if they're not the best with money, at age 18, that will convert into an adult ISA that they could access themselves. If they're not the most sensible, well, they'll be able to access that money from 18. So you might want it towards the house deposit, but if they want a lot of nice trainers or handbags or whatever they fancy, technically that's their money. So it's just something to consider in terms of family planning for what you want that money for. Okay. So this slide is very busy. So again, I can send copies out for anyone who wants to refer back to it in their own time.
Can I just before we move on, because people have asked about the ISAs. So just to be clear, a help to buy ISA is different from a lifetime ISA.
Yes. So a help to buy ISA, you can't take out new ones anymore. So the government replaced them essentially with a lifetime ISA. If you have a help to buy ISA from when they were available, you can still use that, but you can't have a lifetime ISA and a help to buy ISA and have a bonus for your first home from both. So you can only take the bonus from one towards your first home. So it's just something to consider if you do have both of those type of products.
And if somebody is looking to get a lifetime ISA for their first house, how long should they have a lifetime ISA before they need to apply for the mortgage?
So there's no set time scale. So essentially, even if you've just got some disposable money that you want to save up for, but there's no immediate horizon to buy a house, it's great to put it into that lifetime ISA because you'll be able to claim that bonus whenever you get to the point in the future of buying that first home. Even if you're within a closer time period, any bonus helps towards that deposit. Like we know it's a big goal to reach to save a deposit. So there's no set time scale. Normally with a lifetime ISA, they don't allow withdrawals within 12 months though. So just be careful. If you're setting it up because you want to buy a house in 3 months, it's not really going to make any benefit for you.
Okay, thank you. You can carry on now.
So I won't talk too much on this slide, but I'll send it out if anyone wants a copy. But as financial advisors, what we do is say, well, what money have you got in bank accounts? What have you got in pensions? What's in ISAs? And as we get later in life, if you want to supplement your salary from your investment income or your pension income, it helps to have a range of different investment or cash sources to use, because we can say, well, how can we make an income that's liable to the least amount of tax, essentially, to try and make things work for you? And that's where our expertise comes in to say, we'll make the most of all of these allowances to build a range of pots to put you in the best position moving forward. So that's where we come in to structure things in the best way for you. So just remember this, if you remember anything, if you don't use it, you lose it. So your ISA allowances and your pension annual allowance, they will reset every tax year, so April to April. With pensions, there's something called carry forward that you may have heard of in your workplaces before. Whereas if you've made the most of your pension allowance for this year, but you didn't maximise it the previous 3 tax years, sometimes we can make a slightly larger contribution for you to carry forward those previous allowances. So again, if you're not sure if that's applicable for you, speak to an advisor and we can figure out the calculations for you. One thing I really think is important to mention is the personal savings allowance. So we know that over the last 12 months or so, interest rates were a lot higher than we've been used to. So you could quite commonly get a savings account or a cash ISA with about a 5% interest rate. If you earn more than £1,000 in interest on your cash savings within a tax year, HMRC are going to become knocking for some income tax above that £1,000 of interest. So it's just something to consider. If you've got cash savings that aren't within an ISA wrapper, maybe we should consider moving that into an ISA, because any interest and growth within the ISA isn't liable to tax. So again, we can just move things more efficiently for you to avoid extra tax bills that you might not be aware of that might come tapping up for you. So I had several clients over the last year who suddenly got a letter through the door saying you owe us some tax on your cash savings. Okay. So I'll hand over to Debbie for this bit, just for a little bit in terms of the mortgage checklist.
Yes. Lovely to meet you all. So thank you very much for letting me join. I'm very grateful also to Nadia for drawing this to my attention. So mortgages, I've been in this industry for many, many years. Mortgages I've done for the last 10 years or so. I think one of the most important things with anybody, if they're looking at buying a first house, moving house, you know, anything along those lines, is that you really speak to somebody first and foremost, i.e. a broker, as I am. The difference between a broker and a mortgage advisor: as a broker, I can access all the mortgage deals on the market for clients, which means that you get the best rate without you having to go into 20 or 30 different institutions to check the deals out there. So that's sort of the first thing I would say. But also what I do is I will get you mortgage ready. So whether you've never spoken to anybody about a mortgage or a house before, you think, oh, hey, I don't know what I'm doing here. Can you just help me understand the process? The first thing I'll do is talk you through the process. So that will involve talking to you about, you know, do you have a deposit? Let's help you save for a deposit, make some suggestions to maybe working with Nadia. Putting money onto cash if you're buying in the immediate future, having a look at what debts that you've got and reducing those, or ideally trying to pay them off, especially if they're on an interest rate. I see it regularly. They're paying 25% on their Barclay card on a debt, and their savings in the bank are earning 3%. So you're better off to try and get rid of those debts if you can, because it helps you moving forwards. We alluded to it earlier on about a lot of people don't know what their expenses are every month. It's a really great idea to, and I do it all the time with clients, just list down what you spend, the things you have to spend every month. So in a house, you've always got to pay the electric bill, the gas bill and the water and your council tax. But on top of that, there are things that people won't give up to pay their mortgage. So it might be they always go to the gym and can't live without it. But it's really useful exercise, and I can do that with you, to list down what you spend so you can see, right, well, actually, do I really need to buy 5 Costa coffees a week, which are costing me £30? Maybe if I'm buying a house, I might save that money instead into a savings account. and then maybe just go once a week to do something like that. So the little economies that can be made should you want to do that. But the other thing I will do is I said in walking you through the process, so we'll have a look at, what your deposit is, where you want to get to. Deposits, ideally, you need at least 5% of the house value. So when you're buying a house, the better deposit you've got, the better interest rate you will receive on your mortgage moving forwards. So linking into that process, the other thing I will talk to you about is let's have a little look at your credit history. So we can get that printed off, so you can just make sure you haven't accidentally forgot to pay a bill that might impact you a year later when you're trying to buy a house. If so, get that tidied up now so that we know that you're in a really fantastic position. The other thing I do is walk you through the whole process. So people will say, well, when can I look at a house? How do I know the estate agent will let me? How do I know what price I can go up to? I will work all that out before I then say, off you go and have a look at, talk to the various estate agents and go and view some houses. So I will ensure that you know exactly how much you can borrow, but also the key thing is, what's that going to cost you every single month? Because it's all very well saying, oh yes, I'll have a mortgage of 300 because I can afford it. But if that means you can't do that lovely holiday or buy that new car, then maybe we have to sort of revisit your aspirations as to the house and the area you want to buy in. But I help you with all of that. So the first point is talk to a mortgage broker, and that's better than going directly to your bank, because your bank will only give you their products, and they're also won't necessarily have that ongoing relationship with you. So I will be with you from day one when we first meet, and you say, Debbie, I don't know what I'm doing here. I don't know where to start. I will hold your hand through the whole process. And to the extent and it's a bit of a quirky one, but I say to my clients, please send me a photograph of you with your door keys of your new house when you move in, because that's the important bit, it's your new home. And the amount of clients I get doing that, so we've done it. I said, no, we have, I promised I'd get you there. And so I have take great pleasure in giving that personal level of service and helping you. So the other thing I would do is we help you to establish, really how much it costs you to buy a house, not just the mortgage, but the other bits you've got to pay for, the solicitor, your survey. You may or may not have to pay stamp duty. It depends on the level you purchase at. So there's a whole range of things I do to get you, as I call it, mortgage ready. And it's that's a bit of a quirky one, but you can then say to the estate agent when they say, can you get a mortgage? You can say, yeah, I'm mortgage ready because Debbie's sorted that out for me. And then you and I as a team are in a really good place. The other thing I will make sure is that you remain in the home. These things are optional, but again, if you are only paid at work for, let me say, something called statutory sick pay, then we have the option of protecting your income if you want to. And what I mean by that is, rather than rely on what the government will give you if you're poorly, we can protect typically up to 60% of your salary till you retire, because that means then if you do, have an accident or this doctor signs you off with anything, it could be, then this policy will ensure your mortgage and your basic bills can always be paid. And that's called income protection. But then there's other things connected to that, like life cover, which people are probably familiar with. The other thing to sort of consider with mortgages is I will talk to you about, if interest rates go up, how that will affect you. So I don't look at you can afford the mortgage today. What happens if in 5 years' time the interest rate we've selected with you has increased? What's the impact? Now, if your salary is going to continue to go up, perhaps the impact isn't too significant, but it's helpful to know. Let's just say in 5 years' time, if God forbid interest rates were 7 or 8%, is that mortgage that's well affordable today going to mean in the future you are really having a problem? So we assess all of that when we're talking to you. The other thing I would also explain is that in terms of being classed as a first-time buyer, you are only a first-time buyer if you've never had a home before. And that's kind of a strange one. People, if they inherit a house, then you're not classed as a first-time buyer when you move forwards. But again, we can talk about that. The other thing that I will do with all clients is people's incomes now are quite unique. Some people will be self-employed, some people will be contractors, they might be trainee doctors, dentists, nurses. They may have been running a business for a short time. Again, because you come into a broker, I know which lenders will look at those types of people who, when they want to borrow money for a house. Previously, when I worked just for one organisation, when I worked just for a bank, I'd have to turn those people away if it didn't fit their what we call criteria. So, but the benefit of somebody like a broker like me is I know exactly which lenders to approach for you. So there's always a deal out there for people. It's just I will do the legwork for you, which I think is great, and I will support you all the way through. The final thing I would add on that is I will help to educate your knowledge, because my job is to make sure that I don't just get you into debt to buy your home, but to make sure that you understand, how does this mortgage work? How do I make an overpayment if I want to, if I get a bonus? What happens if I want a mortgage I can budget every month, i.e. a fixed rate? What happens if I want to take advantage of the Bank of England rate reducing, so my mortgage costs would go down? Then again, I'll talk to you about those different types of mortgages and how they work, so that you understand both the pros of those mortgages, but also the things that aren't such an advantage to you, so that together we can make the right decision for what suits you and your families. So I think, really going back to the very beginning, your first port of call when you're wanting to buy a house or even move house is to talk to a broker, because that way we will put you on the, just like Nadia will, put you on the sort of the best footing, so that your beautiful home that you see and want to buy, your offer is accepted on that house, so you're not disappointed. So there's lots of things I've kind of covered there for you. What was I going
We
to
have we
say?
have had
So
quite a few we have quite a few questions come through, so if you want me to go through
fantastic. Yeah,
those.
that would be it.
Yeah.
Yeah, that's great.
So we've had a few questions. This is it. So somebody's asked, how much is a standard deposit? And you said people can do 5%. I know that you can't answer that question unless you know how much the house is, but on average, let's say the house is 300,000, what would a
Yeah.
5% deposit look like?
Well, a 5% deposit would then be £15,000, which is 5%.
And
So,
people need, like you've been mentioning, people might have that money, but they've also got to then consider what you were talking about, things like the solicitor's fees and all that sort of stuff, haven't
correct.
they?
So what I always say to everybody is have on one side an extra, typically about £5,000 for your expenses. That's a bit more than you need. However, I would always say, when you move into a house, there's probably always going to be something that's broken when you move in. It might be, you need, you know, hopefully that boiler won't break a month after you move in. But if you've got a little bit of money set aside on top of your deposit, then it's sensible, because then you're not going to suddenly think, oh, I've got to go and take a loan out to pay for that.
And that can be true even if it's a new build property. I think people think,
Correct.
oh, I'm buying a new build, everything's going to be perfect, but
Correct.
it's not. So that's
Correct.
really, really important advice.
I mean,
Um,
5% is the minimum, really. If your parents or families can help you out a little bit more, that's helpful. And in some cases, I get this a lot with people who are doing buying their first home. Mum or dad can go on the mortgage with you to support the lending to get you into the home. I won't complicate with the terminology of that, but if dad, has an income, there's no reason why he can't do that with you. And then we can take him off again once salaries go up if you want to. But
and
deposit minimum 5% of the purchase price. So on 300 would be 15,000. minimum.
And then how do people build up a good credit history for when they're thinking about
Okay, so credit history. So you need to make sure that you're paying all of your bills, your mobile phone bill. If you've taken a car loan, you have to make the payments every month. You shouldn't have late payments on anything where you borrow stuff. So it might be your Marks and Spencer's, your Next store card. Really, all of those you have to make sure you're making those payments every single month. It's not okay for things to be late. So my tip is have a minimum payment set up on all those cards. So if you get busy and you're poorly, at least the minimum payment goes out, which keeps your credit file safe. Your addresses have to match your bank statements, your driving license, the address on the driving license should be the same as where you're living. A lot of people just forget now because everything's online. So really that type of thing, if you've got significant debts, I do sometimes see, people who've got 25, 30,000 on credit card. That has a real bad impact when you're looking at borrowing money. People don't like it because that's on a credit card, it's classed as a commitment. It will significantly reduce what you can borrow. So, I always liken back to when I first started in the bank when I was 19, many, many years ago. We had to balance our bank accounts to the penny, otherwise we were taken into the branch manager to explain why we wasn't managing our money properly. So going over overdraft limits, not good. If you've got £1,000 limit, you shouldn't be going over to 1,020. It impacts your credit file. But what it taught me 30 years ago was to manage my money effectively and to make sure that I didn't go over my overdraft or I didn't, miscalculate. And with internet banking today, it's not as easy it used to be when I first left school. When I left school, you had a checkbook. You wrote your balance in when you got paid. You deducted the check that you'd written in next, and then you knew what was left. So things like that, it's just effectively managing your money so you don't overspend. So I don't know if that sort of kind of answers the question.
Yeah, and then we've had other questions just come through about you were talking about credit when we're talking about credit rating and credit score and paying
Mm,
bills on time, all that sort of stuff. I'm just conscious that there might be people on here who they still live at home with their parents, so they
yeah.
might pay a phone bill, but that might be all they pay. How,
Okay. What I
what
would, yeah,
what
what
are
I would
their
say then, yeah, if you get a credit card in that instance, just put, £50 of petrol on once a month and pay it straight off. It will help to build your credit score.
Thank you. That's helpful because
If
I'm
you've
just
got
thinking of people who are
Yeah,
on
if you've
here that
got no credit, that's not good either because you never know if you can manage credit.
yeah.
So to take a credit card, to take a store card, it's a very good thing to do, but it's not good to run up a big debt on them and not pay it off.
Um,
Leave a debt every month. So that helps to increase your score.
And then another question is, how if somebody was going to contact you guys and ask you to support them, how much would your services cost?
I'll cover that first, Nadia, for me. Yeah. Okay. So for me, your initial appointment with me doesn't cost anything, and not at all. So I will have somebody approach me and say, Debbie, I want to buy a house. Can you talk me through the process? We'll have an hour interview. Um, I'll send them off then to the estate agent to go and look at houses. They come back. We talk all about how we're going to purchase it. We agree all the terms and conditions. And only when they say, right, Debbie, yes, I want to proceed, at that point then, and that could be 12 months down the line, I can help people for 12 months. There's no bill. Yeah. But once they come to say, yes, I want to apply to buy that house, we then charge a fee of £395. So you get loads and loads of help and the benefit of my many years' experience in the industry.
Thank you. And same question to you, Nadia.
Yeah, so it's again similar complimentary consultations until we figure out if you actually need any advice or a recommendation to be made. So your first appointments, there'll be no charge whatsoever. If we do make an actual recommendation to move something, to consolidate, make a new investment, it's typically an initial advice fee, 3%, 2%, 1%. So it tapers down depending on the amount that you're wanting to invest. So essentially it's proportionate whether you have a small investment or a large investment, it will only ever be the same amount regardless of what you're looking to cover.
Brilliant, thank you. I think we can let you carry on with your slides.
So I just popped this in that I know, Debbie, we went through them again yesterday afternoon, didn't we, about kind of mortgage calculators online. And even if you're not in a position to look for a home at the minute, you can input different house values, different deposit values, and you can play around before you even have initial conversations. So it gives you that little bit of a guide of, well, if I'm looking at a house that's worth this much, realistically, what kind of deposit am I going to have to come up with to be able to move forward? So it's just a little bit of fun to do in the background before you want to approach any formal support.
And if I could just add one thing to that, yeah, they're helpful tools, but the result is only as good as the information you input in the first place. So for for a lot of people, they don't know the balance to put in for the percentage payment that they make on their credit card every month, and that's and also there'll be so if you are self-employed, again, there's certain ways you have to put that information in which you won't necessarily you won't know unless you come to a broker. So I almost put a jigsaw together with every case, because it's about a calculator, but it's also about all the other things that might impact. So your credit file might impact it, the fact you could have had a late payment somewhere, you might have a small deposit, there's lots and lots of different things. So those calculators are really only an absolute guide, and the best thing really to do is to speak to a broker first and foremost, because I have access to everyone on the systems for all of the different lenders, but I've got the inside knowledge of having worked for lenders, knowing what they look at and what can trip us up when we move forwards to buy a house. So I'll make sure that sort of doesn't happen and we don't get tripped up.
And one thing I will just add on there about the credit files. So places like Experian, if you pop them into Google, you can normally get a free account and they'll download what your credit file history is at the minute. So you'll be able to see, have I made any late payments that I'm not aware of? Is there anything that I need to work on to build my credit history? So especially if you're living at home and maybe haven't had much exposure yet, you'll see if there's anything on that report and say, right, I need to go out and take this action to put myself in a better position. So it's just something to think of. So in terms of protection, so I know Debbie touched on things like income protection if you're off work due to an accident or injury or illness, to make sure that you can continue to pay your essentials. And with income protection, the reason it's usually capped at about 60% of your salary before the accident is they want an incentive for you to return to work, essentially. So they don't continue to pay you just until retirement to be at home but be recovered, essentially. So when taking out your first mortgage, something that's always worth looking at is life cover. So in the event of you passing away, knowing that you'd be able to repay that debt on the home, if you have a partner who would still be there wanting to live in the house, at that emotional time, it takes that pressure off that the mortgage is repaid and they can then have that moment in time to recover and move forward in terms of their own planning. Also worth looking at is critical illness. So we are much more likely to become critically ill than to actually pass away. So it's really important to have a look at critical illness policies, because we're more likely to be off work long term or even for a 6-month period through an illness. But one thing I would say, even if you have an existing critical illness policy, it's not a catch-all. It's not, no matter what you're diagnosed with, it will pay out. There's going to be a set list of illnesses that they will cover. So it's really important to explore, if you're looking at setting up a critical illness plan, well, what would it actually pay out upon? So an advisor like myself or Debbie, we can help make sure it's actually something that's going to be beneficial for you.
Yes.
Another one to look at is just family income benefit. So if you are in a couple and say you have young dependent children, so they're under 18, if one of you is the main breadwinner for the household, if that person were to pass away and you rely on their income to run the household and look after the children, well, what's going to happen if that income's suddenly gone? A family income benefit policy can pay out a replacement for that person who's passed away's income until the children are of adult age. So it's again something to consider to potentially protect if you do have young children. And I've just popped a little consideration at the bottom. That's something that our solicitor connections within the network can help you with as well. So do you know how you've actually taken your home out if you own it with someone else? Do you own it jointly, or do you own it as tenants in common? Because depending on how you own it, that depends on what will happen if one of you passes away, and whether the joint owner, the house automatically passes to them. If it's tenants in common, well, that might go to your next of kin, who might not be the person you own the house with. So again, would you want maybe a parent owning half the house and your partner owning half the house? It doesn't logistically work sometimes. So it's just something to consider. Do I know how I own the house? Okay. So popping back onto savings quickly. So we've already touched on the fact about having an emergency fund, and a good starting point being 3 months worth of your expenditure. We actually have templates that we can send over if anyone wants one in terms of your expenditure, that lists out rent, mortgage, electricity bill, phone bill, that can help you with actually going through that in your own time. But it's important saying it's completely personal. So what's an appropriate savings level for one person might not be for another. We've all got different lifestyles, different social circumstances. So you've got to really look at what's important to you and what's an essential expense for you. In terms of regular savings, there's also a benefit if you set up monthly contributions into a saving account. Because you'll be investing each month as the market fluctuates, you'll be benefiting from investing at different points in the market. Whereas if you invest one big lump sum at one point in the market, you've just dropped it at that moment in time, regardless of what's going on in the economy. So sometimes there's actually a benefit to regularly popping into the market at regular stages, and also slowly starting to build up the investments and the savings around you, rather than having to give up a big lump sum in one go. So it's something to consider. There's pros and cons to every different approach that might be the best thing for you. So the final few slides I've got here are something called the Retirement Living Standards. So you can Google this. So it's a website based on a university study that says, well, if there's a one-person household, how much income and expenditure would I spend roughly in retirement if I wanted a minimum standard of living, a moderate standard of living, or to be comfortable? So that's where you can have a holiday abroad, meals out, a nice hobby, play golf, whatever you fancy in retirement. That would be your comfortable section. And it also shows whether you're a one-person household like this top line, or whether you're a two-person household contributing towards your retirement. So essentially what it's saying is, if you're an individual, one person, to live a moderate standard of living in retirement, you need to be able to generate £31,700 a year. So that's a strange number to just say, well, what does that mean in real terms? How much do I need in a pension pot then to get that amount of money a year? And this is where this one comes into it. So for one person to live a moderate standard of living in retirement, you need to have a minimum of £375,600 saved across your pensions and investments by the time you retire. And I don't know if you're like me, I think, oh my gosh, that's a hell of a lot of money to save, even for that moderate standard of living. And what we do, if we look for the comfortable standard, and if there's two people in your household, they'd want you to have saved £697,500. So that's even more that we need to build over our lifetime. But essentially, it's not to scare anyone, but it's to show you that the sooner you start investing and saving for your future, the more likely that you'll be able to have a comfortable standard of living. And these values consider that you will get a full state pension. Because we're all young professionals and we're a good way away from state pension age at the minute, something to consider is, well, will we always have the state pension in the format that it's available at the moment? We're constantly hearing in the news about, well, there's a big black hole in the finances. How are we going to continue to fund public sector incomes? Well, you know, that's where we really need to rely on making sure we've got our own private provision to make sure we can survive in the way that we need to. So as financial advisors, what we do is we'd say, well, if I want to achieve a pot of 375,000 by the time I'm 70, how much do I need to contribute every year for the rest of my life? And we as financial advisors can do those calculations for you to say, well, what's an appropriate level of contribution for you? So sorry to scare everyone, but the sooner we know the reality of things like this, the sooner we can make a difference to make sure that we're as comfy as possible later on. And I just popped this down about why people need an advisor, because if you can get bits of factual information like this, which are complimentary, do it. Always sign up and get that information. But it's actually been proven over time by studies that if you seek that professional advice at a younger age, there's actual financial benefits to the position you're in longer term. So sometimes just reaching out and asking those questions can have a real benefit for you long term. So it's just something to consider. And again, this is just a task to do in your own time. So I always suggest that people do an axis on a piece of A4 paper. So plain bit of paper, draw 2 lines. On the bottom line, do kind of time horizon. So next 5 years, next 10 years. And up the left-hand side, put categories that are important to you. So whether it's family, your career, the steps you want to take, and start plotting out what's actually important to you and what you want to achieve. So whether you want to apply for Future Faces committee, whether you want to apply for the awards, or whether you're looking for a promotion at work, or whether you want to think, do I need some protection in place if I'm poorly? Start to plot out what's actually important to you, because until we think about it, we don't know what the end goal is. We don't know what we're striving for. And I think by writing it out, it puts us on a better trajectory to actually achieve something. Okay, so that's it from me.
Thank you both so much. It's been really, really useful. And I can tell because the majority, we've still got everybody, well, we've got more people on the end of the call than we did on the beginning, which is very unusual for an online session. People normally drop out if they're bored. So this has been really, really useful. If anyone's got any questions, we've got a little bit of time for questions still, but I am conscious of time, so if people do need to get off, that's okay. We've had a few questions that have come through, so I'll just quickly ask those ones. But just question about just going back to the lifetime ISA. Can you physically not put in more than £4,000 into a lifetime ISA? Just, I know you did explain it, but just could you explain that bit again?
So the way they cap it is essentially with an ISA, if you go over the allowances, they can consider the ISA as void if HMRC pick up on it, if the provider consider it, and they can take away your relief of essentially. So you keep yourself within that allowance to make sure that you get the bonus you're eligible for, and no one comes at you saying you're trying to claim more relief than you're eligible for. So it's worth just keeping within those allowances. But you can have a cash ISA, a stocks and shares ISA, and a lifetime ISA, as long as you make sure you keep within that overall limit of the 20,000. So you can make the most of different types depending on what goals you've got.
Thank you. And then I've just remembered, before we ask any other questions, I'm supposed to make an announcement. Drumroll, please. We are doing a different type of Future Face event in September. So on the 5th of September, it's going to be another online session like this. And really excited, but it's with our headline sponsor for the award. It's with Arden University. So I don't think it's live on the website now, but I'm hoping Demi will put it on by the end of today. So do look out for it. But we, as you know, Future Faces, we run the mentoring scheme. So as a Future Faces member, you can sign up and we will match you with a senior leader. But this event is actually for Future Faces members to actually be mentors for university students at Arden University. So it's a really great opportunity if you, for your own professional development, if you'd like to, look at mentoring somebody who's in, just that kind of season before you. you remember what it was like when you're leaving uni before applying for your job. So it'd be a really great opportunity. So the event on the 5th of September is going to be hosted by Arden. It's going to be online, and you can basically ask questions about how the mentoring will work. But it's a really nice opportunity actually for you to become a mentor. It's a really great thing. So I just didn't want to forget saying that. Back to the questions. So we've had a couple more questions about combining a lifetime ISA. So if you're married or you're the half, how does that work?
Yeah, so you can use the bonuses from both of you having the lifetime ISA. It's just the issue of you can't use a Help to Buy ISA bonus and a lifetime ISA together. So that's the only real consideration you've got to make.
Brilliant. I've had another message that's come through saying it's not a question, but just thank you so much for your time. So I know people have been really grateful for this session. I think that's all the questions. Thanks for letting me just jump in and ask, because I just thought it was, when we were doing those sections, it's quite nice, isn't it, to that's in your mind, otherwise you forget what questions you get.
Doesn't it, as well, because it's information overload. So thanks for everyone bearing with us whilst we get through it.
Thank you very much.
And then, sorry, someone's just asked another question about the lifetime ISA. The annual limit, they've asked, I think they were asking, can you only ever put £4,000 in? But it's not. It's £20,000 a year you can put in.
It's £4,000 within a lifetime ISA, but 20,000 total. So if 4,000 is the maximum possible in a lifetime ISA, you can still put 16,000 of the tax year in a cash ISA or a stocks and shares ISA that's not a lifetime. So if anyone needs like a fact sheet or just wants me to write it down for him, just drop me a message and I'll let you know.
Thank you. I think we're clear on that now. But you can get in touch with Nadia, absolutely. But yeah, thank you so much, guys. Honestly, this has been a really, really helpful, just really practical session. And we will send an email out afterwards, Nadia. So if there's any of the information you wanted us to share, please let Demi know and we'll email that to all attendees. The session has been recorded, so if you want to watch it back or you wanted to share it with anybody, please feel free to do so. And yeah, have a great rest of your day. We look forward to seeing you all at the next Future Faces event. So as I said, there's the 5th of September with Arden University, how you can become a mentor as a Future Faces member. And we've got a really exciting event with Colmore, joint event with Colmore Bid at Roxy Ballrooms in September as well, which is on the website you can book on. And we've got another really good event, which is going to be on the 24th of September at Birmingham Museum in the Made in Birmingham Gallery.
Wow.
And it's celebrating the shortlisters for the Greater BYPY Awards this year, 2025. But we're also looking at the history and the legacy of the last 25 years of BYPY. So there's going to be some fabulous senior leaders in the room celebrating as well. So do book onto that event. If you're a shortlister, you can bring your mentor or your manager with you. You can just do that through the website. That's the 24th of September. And don't forget to buy your tickets. If you've not yet bought your tickets for the awards, they're the 17th of October. You absolutely don't want to miss out. It's going to be a brilliant night. Ask your boss if they're buying a table. A lot of businesses don't realise they can buy tables or tickets. So go to your boss and be like, why aren't we going to be there? Everybody's going to be in the room. So don't forget to buy your tickets. Not much, but there is a little bit of sponsorship available still. So if your company wants to get themselves in front of the creme de la creme of talent, that's the night to be at. So there's a few, as I said, sponsorship opportunities available. But yeah, we're going to have 500 people in the room. It's the top talent of Birmingham. If they want their business in front of them, that is the event they should be sponsoring and supporting. Nadia, Deborah, you've been amazing. Thank you both so much. We'll send an email out so people can get in touch with you if they've got any further questions or they want some support from you guys. Have a wonderful day, everybody.
You too.
Goodbye.
You too. Thank you. Thanks.
Thanks.